Hi, good day. My name is Elfreda. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I am discussing the healthcare sector with one of our domestic portfolio managers, Stuart Walsh. So Stuart, as a starting point, healthcare has been in a world of pain from a global perspective. It's the worst performing sector in the US this year, down more than 5%, and it's really had to cope with quite a few headwinds, being Robert Kennedy's budget cuts, regulatory changes, tariffs. But here in Australia, we've actually been a bit more shielded from it, and you've been able to find quite a few nice opportunities in healthcare. So can you, as a starting point, give us a bit of insight into those key differences between the Australian healthcare sectors and then the global/US one?
Sure. Yeah, so I think the market more broadly has been wrestling with a few themes. Certainly Robert Kennedy has created some uncertainty in the healthcare space, but then on top of that, you've got, coming out of the White House, a bunch of initiatives, in particular two that have been the key focus, and they've been the desire to push for most favoured nation pricing. So the US often pays more for their drugs than other countries, but also tariffs, a desire to institute tariffs that reshore a lot of the manufacturing of the drugs that are consumed in the US. So that's been a key concern. One of the reasons why the ASX healthcare sector has probably been a little bit better shielded from some of that than the US market is that the composition of the index here is just quite different. In the US, the healthcare sector is much larger and diversified, both in an absolute sense, but also relative to the index. And you've got some large big pharma companies, and you've also got a lot of the sort of biotech companies, health services providers, and medtech companies. Here in Australia, the healthcare sector is firstly much more consolidated around a couple of, or three or four sort of global leaders in very niche subsectors of the healthcare sector. So, for example, we have CSL, which is one of the global leaders in blood plasma products. We've got Resmed, which is one of the leader in sleep apnea, likewise Cochlear, who's the leader in cochlear implants globally. They're very small parts of in a global context, very small parts of the global healthcare sector, but very important for us here in Australia. And they're often exposed to quite different dynamics compared to the broader healthcare space. So, for example, just taking the tariffs, whilst that has a potential to impact a lot of the large manufacturers, quite a few of the stocks on the ASX have actually been relatively immune from that. Companies like Resmed, Cochlear, and largely Fisher & Paykel also, given that they are subject to some exemptions from those, for example. So there has been other opportunities here.
So let's focus on one of those names you've just mentioned, Resmed. It's recently reported very good fourth quarter results. Can you share some of your views around it and why you continue to like it?
Yeah, sure. So Resmed is, as I mentioned before, a global leader in sleep apnea. They have benefited from, in particular, been getting earnings upgrades, and that's ultimately what we look for here is good quality, reasonably valued companies that are in an earnings upgrade cycle, and Resmed has certainly been one of those, enjoying earnings upgrades, largely off the back of strong demand for their products, but also margin expansion. And so demand for sleep apnea has remained strong through increasing awareness and greater availability of testing. But on top of that, Resmed has actually been able to expand into the white space left by one of their key competitors, Philips, exiting the market following a large product recall. And on top of that, have launched a bunch of new products, in particular the AirSense 11, which is their new generation device, which offers better patient outcomes and experience, but is also higher margin. But the challenge for them was that at the point in time when Philips exited the market and they were racing as fast as they could to try and fill that space and keep up with demand, they also were struggling with supply chain challenges, in particular the shortage of chips, which meant they were just racing as hard as they could and incurring extra costs to do that. And now in a more stable environment, they're finally able to eke out some of those margin benefits and gains that they should have previously experienced through that increased scale and those new products. So that's been very good for them. We're certainly seeing that come through, and that was evident in their result last week, that margin impact. And on top of that, that's ultimately flowing through to better free cash flow for the business and returns to shareholders. And they're able to do that at a time, particularly given their net cash balance sheet, as they also invest in R&D and the ecosystem to further expand their lead. And so for that reason, we think that extends the longevity of this earnings upgrade cycle, and it still remains a key holding in the portfolio.
Well, great. Thank you very much, Stuart. And for more information from Stuart and the team, and good luck for the reporting season coming up, by the way.
Elfreda.
Visit us on alphinity.com.au. Thank you.